Okay, welcome back. I'm Charles Goddard. This is video 2 of me trying to persuade you that you can do this. So you should have taken a little time to look at the chart in the last video and looked at my little yellow circles and just tried to figure out what I was on about. And what we're going to do today is go through that a little bit. And remember, our positioning is that you are a rank beginner. So let's go and take a look at our setup, and I'll explain to you the trade. All right, so here we are at our chart of Apple, and we're looking at the three yellow circles. And so when we first look at a trade, and I'm going to give you an example here, and there are several others that we will work on, but essentially the first thing we're going to do is establish the trend. And so you're thinking, okay, trend, I don't know what that is. So the trend is going to be up, down, or sideways, and that's basically the actions of the marketplace, stocks, commodities, whatever, in general, up, down, sideways. And so what we need to do is figure out, well, what's the trend? And I'm going to show you different ways of identifying, but I'm going to show you one right now as a rank beginner where you can identify the trend. So what we've got is we've got three moving averages. These are what are called exponential moving averages, and that is explained to you far more fully in the course. But in the meantime, the red moving average is what's called an 8-period moving average. The blue is 21 period, and the green is 55. Now I say period moving averages because what they are is determined by the time frame of the chart. Now in this case it's a daily chart, therefore that's an 8-day moving average, 21-day moving average, 55-day moving average. Okay, so what's the easy way for us to know what the trend is? And the easiest thing you can do is take a look at the blue line and the green line. If the blue line is below the green line, we would call that a downtrend. If the blue line is above the green line, we would call that an uptrend. That has got to be easy for you to see right there on this chart. And so now we only want to trade with the trend. You've heard that old expression, the trend is our friend. And like I said, we're going to examine other ways of establishing trend, but this is an easy way. So what we've got then is our trade will be when the 8-period or 8-day moving average crosses the blue, we are going to get in to our trade. And but as you can see, the first yellow circle, there's a crossover there. The red is crossing the blue, but the blue is below the green. Therefore, we can't get into this trade just yet because the trend is still showing as down. So then we are watching. We've got the red moving average above the blue. We like this, the way this is starting out. And then the second yellow circle, you can see the blue line has crossed the green. So our belief now is that we are entering, even if it's only for a brief time, we're entering a bit of an uptrend. So you can see right there in that yellow circle, the blue line crossing the green line. We are starting onto an uptrend, and so we will enter the trade the day after that cross occurs. So at the end of the day, on the close of the market, and we'll go through this in detail, but just accept right now that when that line crosses, on the close of the day it crosses, we're going to put a buy just above the close of that day, because the red is above has crossed above the blue, and now the blue has crossed above the green. So the red has told us we've got a trade, it's above the blue, and the blue above the green is now telling us the trend is starting to be in our favor. So we put our buy trade in just above the close of the day that saw that cross of the blue above the green take place. Now, as you're looking at this, I have said that we need to protect ourselves also. So we'll come to that in just a minute. As we follow the price on up, which has very nice, like, hey, this is great looking at it in after the fact, but it's especially satisfying when those things come together, when we were sitting there as those lines crossed and the price went in the direction we wanted. So now as we follow this on up, we can see a yellow circle where the price, not the red, you'll note that there's a difference here. The price is more immediate, and when the price closes below the blue line, we are out. That's the end of our trade. So we put a sell ticket in just below the low of the candle that closed below the blue line. So in other words, just to give you an idea here, the moving average crosses the blue, and the blue needs to be above the green, and that gets us into the trade. But this is a quicker exit than what got us in. We just want the price itself to close below the blue, and we are out. And you can see that that is a very satisfactory outcome for us, where we got in, where we got out, and we did okay with that. Now, the thing that people have trouble with, and we will deal with in this course, is once I'm out of something, I can't go back to it. And of course, that is nonsense. If we've got signals, we will quite happily trade Apple till the cows come home, and going short would be one of the things, and I won't muddle you up with that one just yet. It's one of those things where people give you the sign of the witch and all kinds of stuff if you mention selling short. But we will be covering that in the course, because as I said, the market goes up, the market goes down, the market goes sideways. We definitely want to make money on the way up. We would like to make money on the way down, which we can once I show you that. And sideways, I'm never that keen on trying to trade the range, but I will show you how that's done also. So as we go forward from here, our next bit is to, well, how are we protecting ourselves, where are our stops going? And you can see, for example, where the first yellow circle is, there is a little gathering of candles there, which could be construed as support. So for us, that makes a very good spot to put our protective stop. So we're going to buy in at the second circle, and we're going to put our stop loss under that support. The idea here is that we need to allow our trade to breathe, but we also don't want to lose our shirts either. And so this is a big part of you being able to do this, is to understand risk management. So we're going to put our protective stop just under the low of in that first yellow circle. We're in the trade and we're out on the third circle. Now chances are along the way you can see a little pushback in the price as the price comes down just past the second yellow circle. Now once that clears through resistance, which we're gonna go through, don't panic, we would move our stop to just underneath that green candle that touches down on the little green line. You can see it just past the second yellow circle, and that's our stop would be moved up to just under that candle, and then the price continues on up. And I'll show you different forms of stops, how we can put on a trailing stop and trail this up as another way of simply getting out automatically. In other words, when we're getting out of a trade, we're getting out. We're not sitting around wondering. We're not crossing our fingers. We're not hoping. We're not sacrificing any chickens to any gods. We are just letting the price dictate a way out, and the price will then dictate when we get back in. Okay, so let's move on to the next slide. Okay, so what I've just shown you on the previous slide is a actionable trade system that you can use now. So I feel somewhat responsible in the sense of telling you how you protect yourself now. If you're going to go ahead and trade based on that, you can. But I want you to therefore take in what's being said on this slide and follow it. So the difficulty, as I've worked with students over the years, is they seem to have a problem with sticking to what's on this page, and mainly it's because they get all excited about a trade, and I'll never forget one guy who said to me after he'd lost pretty much 80% of his portfolio, said, well, it was such a good trade, I just had to go all in. Well, never anywhere did we ever discuss going all in as a strategy. And so if you are going to be successful in trading and investing for yourself, you must follow your process. And what's on this slide is a one aspect of your process. So number one, capital allocation, no more than 10% of your portfolio in any one trade. Now I'll say that with a little disclaimer that I'll go over at the end. Number two, you're going to place your stop so that if you get stopped out, you have risk no more than 2% of your portfolio. Now what happens when we're using percentages? If we start with $100,000 portfolio and it grows, and so now 10% of the trade, obviously the trade's getting bigger. And if the portfolio was to shrink instead, then the trades would get smaller. It's a self-adjusting way to keep you trading, to not blow up your account. Now, I'm going to show you a way where we've got 10% in one trade, but when that trade becomes risk-free and we get another signal in the same stock or commodity without being stopped out, then we're going to add a second position. I'm going to show you how to do that without taking on any more risk. It'll be in the book that you have, so it's not like you have to buy this course to learn that. Show you how to do that in the book. But so please take a look at this slide and make sure that you're taking it on board. And if you are going to try trading the moving average, the little moving average system that I've just shown you, then please make sure you adhere to what I have laid out here. It is vital. And that's it for this video. The next one will be along shortly. So take care, and I'll see you soon.